Ladies and gentlemen, good day and welcome to Poonawalla Fincorp Limited Q1 FY23 results conference call hosted by Ambit Capital. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Bijal Thakkar from Ambit Capital. Thank you, and over to you, ma'am.
Thank you, Michelle. It's our pleasure to host Poonawalla Fincorp's earnings call. The company is going to be represented today by Mr. Abhay Buttada, Managing Director, Poonawalla Fincorp, Mr. Sanjay Miranka, Chief Financial Officer, Poonawalla Fincorp, Manish Jaiswal, MD and CEO, Poonawalla Housing Finance Business, Mr. Mahendra Barodia, Head Collections, Poonawalla Fincorp, and Mr. Manish Chaudhary, President, Poonawalla Fincorp. Welcome, sir. And I now hand over the call to Mr. Buttada, Managing Director, to make opening remarks.
Thank you so much, Bijal. So good afternoon, everyone. Welcome to the Poonawalla Fincorp Quarter 1 FY23 earnings conference call, and trust you are all doing good. So let me take you through with the key highlights for the quarter. I would like to start it by saying this has been a fantastic quarter for us. We have translated our strategy into execution, and results are there for all to see. Our PAT increased by 108% year-on-year to 141 crore. The AUM stands at 17,660 crore, up by 22% year-on-year. Disbursement increased by 98% year-on-year to 3436 crore. Our cost of borrowing reduced by 264 bps year-on-year to 6.9%. Our NIM grew by 155 bps points year-on-year to 9.5%. In terms of asset quality, GS3 reduced to 2.19%, down 319 bps year-on-year, while NS3 reduced to 0.95, down 176 bps year-on-year. Our ROA improved by 155 bps year-on-year to 3.4%. Our capital adequacy stood at 46.1%. We have created a management overlay of 224 crore on our legacy discontinued book. We initiated our capital market journey with NCD issuance of 250 crore. Similarly, on our housing subsidiary, PAT increased to 30 crore, up by 248% year-on-year. AUM grew by 31% year-on-year to 5282 crore. Disbursement increased to 535 crore, up 115% year-on-year. And GS3 and NS3 stood at 0.87% and 0.54% respectively, down by 107 bps and 71 bps year-on-year respectively. So our execution excellence has ensured this quarter has been better than last quarter, despite quarter 1 generally being a muted quarter. Our organic disbursement has seen secular growth quarter on quarter since quarter 1 FY22 and stands at around 80% of our total disbursement in this quarter, as it grew 27% quarter on quarter. The organic disbursements have grown from over last 3 quarters, from 1295 crore in Q2 FY22 to 1543 crore in Q3 to 164 crore in Q4 of FY22. In Q1 FY23, we did 2738 crore of organic disbursement. Strong disbursements on back of excellent organic disbursement growth is a validation of our business model. During the quarter, we have launched new products, supply chain finance and machinery loan, and continue to witness traction from the existing product range. The AUM of focused products continue to register a healthy growth rate of 66% year-on-year and 13% quarter-on-quarter. With focus on direct, digital and partnership model, the distribution stands very well diversified. DDP contribution grew from 17.5% to 34.1% quarter-on-quarter. With our continued focus on technology, we are on track to be fully digital across all our product lines. We have started seeing traction because of the same, as we have become a lender of choice for our customers as well as partners. Let me take you through to what we can expect over the rest of this financial year. So I will go point by point. First is in terms of growth opportunity. Despite disturbances on the macroeconomic front, India's economy looks far more settled, with systematic strength remaining intact. The high-frequency economic indicators of GST collection, PMI, indicate expansion in economic activity. As indicated by banks, double-digit credit growth number in quarter one, the demand for credit continues to expand. Also in the consumer and MSME segments wherein we operate, there has been a revival in consumption as well as MSME business activity post-pandemic. The company, after its business transformation, is well placed to capitalize on the systematic credit growth in the economy. Digital first. We are constantly making strides in continuously redefining our strengthening right to win strategy. We believe digital capabilities to be a source of competitive moat, a tool for efficient operations, and a driver of sustainable profitability. Since we initiated the journey 4 quarters back, our focus has been on the culture of digital first take-led across all functions of the organization. Digital capabilities for sourcing, underwriting, onboarding, collection, and customer service are in place, resulting in us delivering the best-in-class turnaround time and overall customer experience. This gives us the right to win. Our fintech architecture and digital capabilities makes us a preferred partner for other fintech players in the overall ecosystem and enable us to leverage the strategic partnership in terms of overall customer acquisition and to offer digital first products. In terms of disbursement and AUM, we have reached a monthly organic disbursement run rate of excess of 1,000 crore. So we are absolutely on the track to do disbursement in excess of 12,000 crore. This I'm talking about the organic disbursement for the full financial year. This should help us increase our AUM by approximately 30% year-on-year basis, translating to more than 5,000 crores of AUM growth by end of FY23. In terms of cost of borrowing and NIM, on the liability side, despite the rising interest rate environment and the consequent factoring of higher interest rates in the debt market instrument, we have been able to achieve 264 bips reduction in cost of borrowing year-on-year, with cost of borrowing at 6.9% in Q1 FY23. Though we may see some rise in the cost of borrowing in the upcoming quarter. However, we expect the overall cost of borrowing by Q4 FY23 to be still lower than that for Q4 FY22. We have initiated our capital market borrowing, dynamic management of liability book, optimizing liquidity, continued diversification of our liability would help us retain our competitive edge in our cost of funds. Also, we are passing some of the price increase to the customers, which coupled with the liability side will help us maintain our NIMs at about the same level for the full financial year. In terms of asset quality, we have seen a consistent decline over the last 5 quarters in both GS3 and NS3, which is now stands at 2.17% and 0.95% respectively. We will continue our focus on reducing it further. We expect GS3 to be less than 2% and NS3 to continue to be less than 1% by end of FY23. Our current OPEX to AUM currently stands at 5.6%. As shared during the last quarterly call, we continue to invest in capability building across people and the technology. With further increase in the activity level, we expect the same to reduce drastically from the next financial year onwards. Consolidate, grow and lead strategy which we are following since acquisition of the Magma Fincorp. We have been executing the strategy to the T. In fact, within first 6 months of acquisition, our consolidation phase got over and now we have moved to the growth phase in quarter 4. We continue to be fully committed to our articulated vision and strategy. This is ensuring that we are well on track to achieve our management vision 2025. So with key metrics of disbursement, AUM, cost of borrowing, NIM, asset quality showing excellent performance, we are at the right place, at the right time, with the right aspiration. We have worked across the functions to get a multiplier effect. We will continue our focus on the execution, investment in people, building technology, and a strong retail consumer franchise. We are very confident of our trajectory ahead in FY23 and beyond, and well on course to deliver an exceptional performance in line with our management vision 2025. Thank you everyone, and requesting Bijal we can start the question answer.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles.
Michelle, I think we can start taking the questions.
Okay. The first question is from the line of Shalini Vasanta from DSP Mutual Fund. Please go ahead.
Hi, this is Vivek Ramakrishnan here. My question was on your product suite. You've increased the number of products that you'll have. Is there a single product that will be dominant in your product mix going forward, or is it going to be split very much through all the products? On supply chain finance is usually a very low margin business, a low ROE business. We've seen in for a lot of other players. What is your strategy there? That's the second question. And the third question is there a cross-sell opportunity given the complete diversity in product range that we see? Is there anything which is common across these products? Thank you.
Yeah. So thank you so much. So to answer to your first question on the product side, as mentioned in our overall management vision 2025, we want to be in top 3 consumer and the retail space, wherein we already mentioned in terms of loan to professional and in terms of pre-owned car, we are already in top 3 in terms of monthly disbursal rate in the NBFC segment. And going further, all the retail products wherever we are operating, loan to professional, pre-owned car and consumer finance, wherein we are targeting top 3 position, wherein we'll focus, and again business loan. So these 4 products will be targeting going further. And other products, of course, the growth will be year on year will be 25 to 30%. But these 3-4 products wherein predominantly right now also we are preferred choice of lender considering our last 12 months of experience. Second, considering your answer to your second question on the supply chain side, as of now we have a lot of partners who are contacting us in terms of co-lending opportunity, and we have already done integration with them. So we'll be not able to disclose the name of the partner, but yes, we have onboarded 2 or 3 partners last quarter, and we are getting good margin. So we expect this business to continue. Though there is a lot of competition, but the product proposition and the rate of interest because of our low cost of fund which we are offering, again in that also we are, because of our tech capabilities, because we are getting a preferred choice of option. Considering your third question, cross-sell opportunity. So we are already doing a lot of cross-selling to our existing customer base. As we speak, we have already crossed more than 6,000 chartered accountant disbursement, a lot of in professional loan, in personal loan also we are doing a lot of cross-selling. So we have started getting fee-based income, insurance income, and as and when we will grow, we have started organic disbursement in last 4 quarters. Considering the existing customer base of Magma and considering the new customer base, we are getting good traction in terms of cross-selling, and the way ahead will focus. We have an exclusive team who is focusing on the cross-sell digital. That is our DDP model, wherein we focus on the digital side. So we are getting good traction on the cross-selling. We'll be able to give you more numbers from next quarter onwards on the cross-selling side.
Thank you so much. Look forward and good luck, sir.
Thank you so much.
Thank you. A reminder to all the participants to press star and 1 to ask a question. The next question is from the line of Sonal Gandhi from Nirmal Bang Institutional Equities. Please go ahead.
Sure. So, hello, sir. I have a question on this management overlay provisions that we created this quarter. So, what is the thought process behind it? And second, do we see credit cost for the entire year since we have such large provisions, that we are carrying in our books? So, if you could answer these 2 questions.
Yeah, Sonal. So we have created the management overlay of 224 crore. This is the additional provision, which we have created out of one-time gain, which we got by sale of Magma SDI shares. The provision has been created specifically for the discontinued book. Yeah. So what it does that the discontinued book, which is close to 2,000 crore on book, the provision which we were carrying was 9.3%. It has gone above 20% with this additional provision. And we believe that basis the recovery expectations, we don't have to take any additional hit to our P&L. So the collection efficiency and the expected collection efficiency, we are well placed to recover, in fact, more than what we have already provided for.
Right, sir. And how do we see credit costs, coming for the year? I mean, also I'm coming, if you could give us some sense on the new book that you've generated over last 1 year. So, any initial, signs over there that what is the credit quality of that book? Any slippages? Some color on that. And given both the things into factor, how do we see credit costs for FY23?
Yeah, absolutely. So the entire new book across products, which we are generating, because we have made changes to the target customer segments. I think the experience so far has been fantastic, right? Right from early bounce rates to eventual delinquency. We are not experiencing anything more than what we had anticipated. In fact, the actual experience is far better than our initial business plan. And our expectation, in terms of credit cost is that, on a steady state scenario, our credit cost would remain less than 1%. Yeah, because as you know that, we have gone for a conservative provisioning and write-off policy. Yeah, so after taking that into account, we still expect credit cost to be less than 1% on steady state basis.
Even for FY23?
Yeah, absolutely. Yes.
Okay. Okay. So another observation was our fee income has come down on a Q2 basis, wherein our organic disbursements have gone up. So what has happened over there exactly?
So see, as you know, Sonal, that Q4 tends to be a heightened activity level. Though for us, Q1 in terms of disbursement and overall activity level has further gone up. Yeah. So there would be a marginal change in fee income, but overall, in terms of our ROA tree, in terms of profitability, I think we are well placed even for the rest of 3 quarters in the current financial year.
Understood. And sir, if you could just indicate what is the GNPA as per 12th November circular?
Yeah. So basically, what we have, so GNPA percentage, as compared to March 22 has come down significantly. At Concall level, the GNPA as on 30th June 22 is 3.6%. This number was 5.9% as on 31st March 22. And similarly, I'll give you one more number, which is net NPA. So NNPA, which was 4% as on 31st March, has come down to 1.9% as on 30th June 22. Yeah, so the entire trajectory, and this is what is reflective of the conservative provisioning, which we have followed since acquisition. The second piece, the kind of segments, which we have gone into, it and the rigor around collection, which has been put on ground. So across GS3, NS3, as well as when we talk about GNP, NNPA, it is I think a fantastic story. And we expect even in future, both our GNP and NS3 number to be much better. In fact, our expectation is that as we close this financial year, our GS3 number should be less than 2%, and NS3 number in line with our 2025 vision, less than 1%.
So if I could just squeeze one last question. So the write-off number, I think it's somewhere around 90 to 94 crores for this quarter. So if you could just give what is the write-off that has happened from the restructured book and from the normal book?
Yeah, so the total write-off has been about 105 crores during the quarter. I won't have the breakup in terms of how much is from restructured and how much is from non-restructured book, but it is suffice to say that even our restructured book, which first of all, restructured book by itself has come down significantly. So right now the restructured book is at 619 crore as on 30th June. Out of that, about 45% is a zero bucket book. So and on restructured book, we are carrying a provision of about 147 crore. Again, our expectation is that our recovery would be in fact better than the net of provision book which we are carrying, and hence broadly one doesn't have to see the restructured book and a normal book in a different direction.
Sure, sir. Thank you so much and all the best.
Thank you. Thank you.
Thank you. The next question is from the line of Nikhil Rungta from Nippon India Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for the opportunity and congratulations on the numbers. So 2 questions from my side. First is on the provision side, you indicated that you have taken these provisions for the discontinued book. Last year, if I remember, we took a similar, the amount was significantly higher provision on this existing book. And in the past 2 quarters, we have been seeing that there are write back of provision despite our book being, on the upper trend. So do you think from these provision, we can see write back coming in over the next years as and when that book continues to trend down?
Yeah, absolutely. So on prudent basis, Nikhil, we have made provisions. And like we said that we take pride in our collection infrastructure, and we believe that whatever provision we are carrying in our books, whether on restructured or a normal book, it will put us in good stead in terms of recoveries. And yes, there can be one would always expect and work towards getting some write backs out of the provision which we are carrying. And like I said, that we have been right since we acquired this entity, we have adopted a highly conservative provisioning and write-off policy, right? So obviously, policy is conservative, and your collection efforts are completely on board. Definitely, yeah, there has to be a better write backs.
Okay. And sir, my second question is, last quarter we announced capital raising plans in our housing finance subsidiary. So any update on that?
So Nikhil, right now we have appointed the investment banker, and the transaction, as we discussed last time, it will be completed before end of this financial year. We'll be able to give you more update once we start signing NDAs, and maybe quarter on quarter will give you the update. So we have just appointed investment banker, and now we are closing on IAM and other activities.
Perfect. So that's all from my side, and all the best for the future, sir. Thank you.
Thank you so much.
Thank you. Before we take the next question, a reminder to the participants to press star and 1 to ask a question. The next question is from the line of Shripal Doshi from Equirus Capital. Please go ahead.
And congrats for the good set of numbers. So my question was with respect to the focused book and rather the overall loan book. So in the overall loan book, 30% is from the mortgage business. What will be the largest 5 segments for us on the overall loan book? Because we have not highlighted that. So if you could throw some light on the largest 5 segments and give some color with respect to the percentages, and who would be our peers in each of the landscape?
Yeah. So, hi, thank you so much. So, the largest segment, for us, if you look at in terms of the customer segment, the 2 segments, which we continued from erstwhile organization, one is the pre-owned car, where even erstwhile it was one of the leading organization, and we have in fact increased the trajectory of business as far as the pre-owned car is concerned. Yes, the segment we have gone to far more formal segment as compared to what it used to happen earlier. So pre-owned car is clearly one strong segment for us, and the second segment is the affordable home loan. So we are one of a few pure play affordable home loan company. In fact, with CRISIL AA+, CRISIL and CARE AA+ rating, I think that puts us into the top league as far as the affordable home loan business is concerned. So these 2 are the segments which we are continuing from the earlier avatar. Now the 2 large segments which we have added to this is, one is the unsecured products. Now unsecured, again, this is the segment which is not new to us as a group, because as Poonawalla Group, we had started off as private limited company. It's a separate company, Poonawalla Finance Private Limited. For about 2 years, we were doing digital lending in unsecured space. Yeah, and the products were business, personal loan, loan to professional, and business loan. The best part is that the entire 2.5 year period of Poonawalla Finance coincided with the pandemic. Yeah, despite that, the performance of the book extraordinary, and now with another year of experience in Poonawalla Fincorp. So we launched unsecured products in the Q2 of last year, and now we are seeing the traction across the product lines month on month, and to our liking. We talked about the performance of this book again is better than what we would have expected. So basically, again, an unsecured, while it is a year-old product as far as the Poonawalla Fincorp is concerned, but we have an experience of 3 years in the unsecured space. So that's the third vertical. Fourth vertical which we added in Q3 of last year, it is the loan against property segment. So this is where we are again targeting a high quality credit-worthy formal segment. So these are the 4 large verticals which are there. Now there are few product variants I would say we have launched, which is the machinery loan, medical equipment loan, and supply chain finance. Overall, and go forward, we are going to launch products on consumer durable side. We will launch on merchant advance side, as well as we are exploring what is going to be the best play, what should be the best play in the EMI card and credit card segment. However, the existing as well as the new product which we have already launched, it should basically, even on a steady state scenario, should give us 90% plus of our business. So broadly, our targeted bouquet is already there as offering to our customers. Now, in terms of overall secured, unsecured, so you asked about the mix. So right now we are having a mix of 76-24, 76 being secured and 24 being unsecured. Yeah, on a steady state scenario, that mix would be somewhere around 60-40, 65-35 as things play out. And as we get more experience of new products, the markets, etc., we'll look at optimizing the mix.
Got it. Thank you, sir. So in the POC, I think I remember we are the 5th or the 6th largest player there, right? And in affordable, as you had thought of the 4th largest probably lender there. In the unsecured product segment, so who all would be our predominantly competition?
So Shipal, all the NBFCs who are doing this lending, we compete with them. To name a few, the likes of Bajaj, Tata Capital, Aditya Birla Finance. I think these are typically the players who are present in this segment. Having said that, we really look at ourselves being specifically focused on the formalized income segment here. And that is where the differentiation comes in. I think even on the unsecured side, you have a huge spectrum which is available. We cater to the topmost spectrum here. We are catering to to those who are actually having some credit history available with them. They're not new to credit per se. And these are, especially on the business loan side of it, these are people who are covered under the GST regime for us to be able to underwrite them based on the cash flows there.
And just to add on POC side, we are amongst the top 2, top 3 players in the NBFC space. And this is when we have within POC, we have identified super credit worthy segment. So for example, we don't do commercial side of pre-owned car finance. Even then we are among the top 2, top 3 players in the NBFCs.
Right. I think the 5th is including the banks, right? I think it's 6th.
Yeah, absolutely.
Right.
Yeah.
So one question with respect to the disbursement. So in the last 4 quarters, we have disbursed close to 11,500 crore of disbursements. So how has been the slippage for that particular fresh disbursement that we've done? If you could give some qualitative color or some numbers there, would be very helpful.
So, Shripan, in terms of the fresh business that we've done, I think as Sanjay outlined it earlier, the performance has been, better than what we have kind of budgeted for. There are no slippages which are beyond the expectations that we had. Even on a new portfolio basis, the way if I look at it, on the early vintages, on their 0+, 30+, I think we are way beyond, what typically the numbers in the industry are. On the bounce rates as well, which is the first level of indicator that we get, we are in low single digits there. So I think the performance for all the portfolio is phenomenal. I think currently on a console basis, if I look at the entire book that we would have originated over the last 12 months, our 30+ would stand sub 0.3%, which will be the best in class today.
Oh, you said 30+ would be something?
Sub 0.3%.
Okay, got it. So just last few data keeping questions. On the balance sheet side, if you could give us the borrowing number and net advances number. And like earlier, we used to give the entire balance sheet. So just a request if we could continue with that disclosure.
Yeah. So I think balance sheet numbers, primarily there are two numbers. Okay, one is the net worth and second is borrowing, okay, from NBFC standpoint. Right. And yes, we can include that slide, okay, again from next quarter onwards. As far as our total borrowings, okay, which is concerned, that our total borrowings has been in the range 800 crore. This is console number. Yeah. And the net worth 6,235 crore.
Okay, sir. Thank you so much, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Harshvardhan Agrawal from IDFC Mutual Fund. Please go ahead.
Coming from which segment, as in the discontinued book or the...
Mr. Agrawal, can you please repeat from the start?
Yeah, sure. So the query that I had was on the write-offs, the 105 crore write-off that we had in the quarter. Wanted to understand as to from which segment these write-offs are coming from.
Yeah. So the entire write-off has been coming from legacy book, right? And majority of them, okay, has been either from pre-owned car segment or the asset-backed financing, okay, which we have discontinued. So the largest portion is coming from asset-backed finance, which is the discontinued book. Then it is pre-owned car. And then, okay, in erstwhile organization, there used to be some kind of SME financing. Yeah, so it's coming from there. And a very small amount is coming from affordable home loan piece.
Right. So when we say the most portion is coming from our legacy book, it's the 2,300 crore loan book that we show currently. Is that from there is the write-offs are coming from?
Yes. So 2,300 crore is the balance book from the existing product line, which we have discontinued. Right. And out of that, more than 50% book is stands in zero bucket. Of the bucket, we have provided enough provision earlier also, and currently because of the one-time insurance gain sale, we have provided additional management overlay of 224 crore. So from that perspective, though it is a policy write-off, we have changed the policy write-off at the time of Magma acquisition. We have done 90+ unsecured write-off and 180+ secured write-off. So we are not expecting any single rupee loss from the balance legacy book of 2,300 crore because of our extra provisioning which we have done towards the legacy book, and we are continuously writing off every quarter. It is only policy write-off every quarter on 90 and 180 basis.
Sure. And so just wanted to understand the provision movement between the number that we put out in ECL and the number that we have put out in the PNL. Because ECL has grown by around 100 crores, but in the PNL there's a negative number. So if you can just reconcile that.
So basically, see, Harshvardhan, as you know, okay, what happens is the book which we would have written off, the book which part of it would have been sold off. So all of that book would be carrying much higher provision, and this only shows that the legacy book has come down significantly as a proportion to the total book. And with the new underwriting being in a high credit segment, right? The ICL provision obviously ought to come down.
Right, sir. But just wanted to reconcile the numbers, as in the ECL, the total provisions have grown by 100 crores, and in the P&L we have taken a provision right back. So just wanted to reconcile those numbers.
So the provision right back, which we have. Yeah, so basically the measure of the difference, which you are seeing in recon could be because of one-time provision, which you have made of 224 crore. Yeah.
Okay.
And right back, whatever I have taken, we have not taken any specific right back of provisions. Whatever has got written back, basis the performance of the book, has got written back.
Okay, sure. And so one last question, maybe on our new products. We see that we have mentioned credit cards as one of the products in our PPT. So this product, is it like we are going to do a co-branded credit card, or it's like we are going to issue credit cards on our own?
Initially, we were exploring the co-branded credit card, but now we are exploring both the option. We are waiting for the further clarification from the regulator side, because we just received last quarter the new guideline. So now we are exploring, and within 1 or 2 quarters, we are going to decide internally whether we will go ahead for the co-branded card or we will launch on our own.
Okay, so basically we'll have a clarity during the course of the financial year.
Yes.
Perfect, sure. Thanks a lot, sir. All the best.
Thank you. Anyone who wishes to ask a question may press star and 1. The next question is from the line of Jignesh Sial from Incred Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. I think I'm audible?
Yeah.
So I actually missed out one data point that already has been you answered to previous question. Can I get a bifurcation of your liability side with your borrowing specifically? As a concern, that is possible even for PSFL, with your PSFL?
You are asking bifurcation between the two entities? The liability side.
No. The borrowing bifurcation. So,
Mr. Sial, you're not audible.
Banks and all that, if you have it.
Mr. Sial?
Yeah.
You're not audible. I would request you to use your handset, please.
Is it better now?
Yes, please proceed.
Yeah, I'm asking for borrowings bifurcation. So between capital market, bank borrowing, securitization, whatever you would have done, can you give me on a console as well as on standalone basis? Am I understood?
Yeah, understood. So basically, our first of all, because we are highly capitalized company.
Yeah.
So and that becomes a very important component of our total liabilities. So 6,235 crore, like we called out, is coming from equity. Yeah. Okay. And thereafter, there is the entire piece of the term loans and the CC lines, from banks. So that accounts for about close to 1,000 crore. We have fixed rated debt of about 2,500 crore. Yeah.
Okay.
So that makes it to the total borrowing for across both the companies.
This fixed rated one will be what? Capital market borrowings, or how will it be?
Yeah, so fixed rate debt is capital market borrowing. Obviously, part of this borrowing, has been there for the time since we acquired this company. Okay. Now, that number would be close to 1,800 crore. And obviously that number over the next 12 to 15 months, it will come down by 80%. That will again give the opportunity for us to reprice and then replace it with lower cost fixed rated liabilities.
Okay, understood. That's useful. Second question I had up was, you said, ignore my apologies for my bit of an ignorance, but you said there is a bit of there is 1,000 crore plus a legacy book, right, which Magma had up and which you're gradually going to write it off and all, and you have created certain provision against it, and you are expecting a write backs also from it. Is my understanding correct?
So let me clarify it. So there is a discontinued book. So there are certain products which were being done by Magma earlier.
Yeah.
Because of we having to do cash collection. And we as a policy, we don't want to get into a business where we ourselves have to do any kind of cash collection. Okay. Now, that is the book, okay, which we call as discontinued book. The total book is about 2,300 crore, out of which one book is 2,000 crore. On 2,000 crore, we were carrying a provision of 9.3%. We have increased that provision to 20% plus. So there's an additional 11% provision, okay, which we have created. And this is the number, 11% is equivalent to 224 crore of management overlay which we have created, right? Now, obviously, on prudent basis, they are looking at the recent experience, bucket movement, etc. And because the book also has become vintaged, right? Okay. So that's where we thought it appropriate to create this one-time provision. Given our collection franchise and the rigor around collection, obviously the objective is that we don't have to utilize that provision completely, and basis our actual collection performance on discontinued book, yes, one would always love to have some write-backs.
Understood. This is quite useful. And lastly, just understanding more on your business strategy side, I understood that you have created already a pretty niche for yourself on the pre-owned car segment and you are already entering into new lending segments altogether. Definitely, this all segments have been pretty competitive one. Even whether it is Bajaj or even as you say Tata Capital or any of the names and all. So how what is the niche that basically Poonawalla as a brand you're trying to create? To make sure that there is a legacy customer coming to you and basically customer base remains little stickier. That is first. And number two, is it specific to any geographies where you're expanding pretty heavily or you're saying? So if you can just give a brief about the kind of customer profile you're handling and what is niche that you are specifically doing. If you can highlight that would be really useful to us.
Yeah, thank you so much. Good question. So from the existing product, if you see either it is a pre-owned car or business loan or personal loan, professional loan or any of the product, in most of the product, we follow a customer select segment wherein with the help of data analytics team, we have started targeting the customer. As of now, the targeting customer is the top rated customer. Most of our customers fall 750 plus CIBIL score. They are in formal income segment. In terms of business loan, cash flow based lending, GST based lending. That is the reason just now, as informed by our colleague, our after 12 months of seasoning, 30 plus is 0.3, and we do not expect any additional changes in that overall range. And our credit cost again we are expecting will be less than 1 for rest of the financial year. So the difference basically the USP here is as compared with the top 3 NBFC or even with few of the bank. One, we are giving the customer experience like a fintech, the product proposition what we have, the transparency, the legacy which we carry from the overall Poonawalla group, the ethics and the principles. So there are no hidden charges. So I think that is giving us good advantage. If you see professional loan, we have, as we speak, we have crossed more than 6,000 chartered accountants, which is around 2.5 to 3% of the total chartered accountant base in India. And entire 100% paperless process, there is no single signature required. So customers, all the professionals, customer in personal loan segment, business loan, they are giving us first choice of preferred lender in NBFC space. Monthly, we are doing constantly since last 4-5 months. We are crossing 110 to 120 crore in terms of professional loans, CAs and doctor. And this is all digital acquisition. This is all direct acquisition. We do not have any kind of direct selling agent. So we save on the onboarding cost. Because of the low cost, we are able to match with the top private bank, even with the top 2 NBFC. And considering our telephonic discussion and the internal survey, so 90% of the customers, their balance transfer from the mid-size NBFC or the mid-size bank, and more than 50% is a fresh lending to them. So overall customer proposition, customer experience, user experience to them. And from the day one thought process was we have started targeting a customer like a bank. We started behaving like a bank in terms of lot of other transparency. So I think we have done much better than our expectation. So that was the answer to your question, why we are different as compared with other NBFC. As after 2 or 3 quarters, you will get to know the segment-wise reporting we will start. So we will get a fair idea. Second, with regards to the location, as of now, we are a pan-India player. Depending on the opportunity, we are open for any location. Because of our digital and the strong collection infra, we don't see any challenge in terms of location. With the data analytics team, we have enough team available as of now. We have strengthened that team during the last 2-3 quarters. So we don't see any major issue in terms of location. Right now, we are covering more than 250 locations for most of our products.
Understood. And just lastly, one more, just wanted to understand, like if I see it, your Concall basis, your ROA is somewhere around 3.4%, correct? And that we are already seeing an improvement of around 155 pips YOY and all. So what is the, on a Concall basis, because you already have a housing subsidy, definitely there the overall ROA will be relatively lower, standard would be definitely be higher. But what's, because ROE is, because you're loaded with excess capital right now, will take a bit of its own sweet time. But what will be your thought process over what kind of sustainable ROA over a period of next 3 years, not immediately, but over a period of, say, by 24-25, you will be targeting to achieve? And considering the NIM already at 9.5, which is substantially good, and considering you already have a pretty decent liability franchise being built in, what would be the contributor in case if you're thinking about it expanding into an ROA or not? Or do you think steady state business 3.5 would be something you would be looking to sustain? Any guidance or any thought process on ROAs? That would be helpful.
Sure. As you rightly pointed out, as we leverage, current leverage is less than 2, so ROE will take time. Once we cross 3 or 4 leverage, that will be the right point to look at that. But in case of ROA, for the current financial year, it will be above 3, in the range of 3 to 3.5. And on a steady sustainable basis, anything between 3.5 to 4, which we would like to see 2 years down the line.
Understood. So now incremental ROA, suppose if I assume that another 25-50 whips, if you want to achieve it, will it be more of a NIM expansion whereby you will be getting into more lucrative products altogether, or you will be thinking about, because anyhow provision is not a concern for you at least at this point of time and all. So considering that steady state business, you maintain your book well. So will it be a NIM expansion that you will be looking out for, or you thinking about cutting down the COPEX or fee income or something like that? Just thought over it, if you have it.
Yeah. So see, our ROA, reported ROA is 3.4%, okay, for the quarter. Yes. Normalized ROA is 3.1%. And like Abhay said, okay, on steady state basis, okay, the objective would be to get to the ROA of 3.5 to 4%. Now, as far as the NIM is concerned, I think our legacy book, because of the customer segments, okay, it was operating into, it was at a much higher yield. As that book keeps coming down, while okay, during the current year we expect a NIM trajectory to continue, but on a steady state basis, okay, the NIM level could be lower than 9.5. However, there's a significant amount of operational efficiency which will kick in. Right?
Okay, understood.
So, and that's where we expect from normalized ROA of 3.1% for Q1 on a steady state basis. Okay, we expect this ROA to improve further.
Perfect. This is really helpful. And just for my knowledge, has Hiren from Bandhan has already joined you guys, or is likely to join now?
Yeah, he has joined. So Hiren Shah, he heads our investor relations.
Okay, perfect. That's really helpful, and all the best, sir. Thank you so much.
Thank you so much.
Thank you. As there are no further questions from the participants, I now hand the conference over to Ms. Pejal Thakkar for closing comments.
Thank you, sir. Thank you, Mr. Butada. Thank you, Manish, for being on this call. And Michelle, you can now end this call.
Thank you.
Yeah.
Thank you.
On behalf of Ambit Capital, that concludes this conference. Thank you for joining us, and you may now disconnect.